Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets and over 80 alternative strategy mutual funds, representing 80% of the AUM of the alternative strategy mutual fund market.
Hello everyone, my name is Lou Johnson. I'm an alternative investment analyst here at AI Insight, where I lead our research efforts for alternative mutual funds. Thank you for tuning in to this short podcast where I am going to walk you through the SEC's newly adopted derivatives rule. This was approved on Wednesday, October 28th, and applies to investment companies including mutual funds, ETFs, closed-end funds, and BDCs. Per the SEC's press release, the new rule and rule amendments will provide a modernized, comprehensive approach to the regulation of these funds' derivative use that addresses investor protection concerns and reflects developments over the past decades. All right, so with that intro, let's dive into this, and we will start by answering the question, why this is important. Well, there's no standardized reporting framework for an advisor or investor to turn to understand the derivative exposure of a registered fund for those that use them. Certain fund companies may summarize net exposures through the fact sheet, but this is still often a limited picture. Outside of that, you would need to analyze the semi-annual financial statements, which have a listing of all portfolio investments for each fund, including derivative positions. This is incredibly difficult, though, as there may be hundreds of contracts. Contracts may be listed in different currencies, notional exposures may not be listed, and the fund may be using various swap contracts, among other challenges. And why is this an issue? Well, derivative contracts are unique in that they allow you to acquire exposure to securities and or a market with cents on the dollar, which creates the opportunity for a fund to lever its market exposure. For example, one of the more common contracts to be used in registered funds is a futures contract, which is an agreement to buy or sell an asset or security at a predetermined price at some future date. These contracts are offered through exchanges that require the investor to post a margin to secure the contract. Now, per the CME Group, this typically ranges between 3 and 12%, depending on perceived risk in the market. Applying this to a fund, let us say a manager commits 25% of the fund's net assets to margin for the purpose of acquiring futures contract exposure. Using the margin range provided and doing some simple math, a fund could theoretically acquire anywhere from 208 to 833% market exposure in addition to any securities the fund may hold. Now, this is equivalent to upwards of 8.3 times portfolio leverage, and it can certainly be higher for certain funds. The dynamics of option contracts are similar, specifically for funds that write options, or put differently, who sell option contracts. When writing an option contract, you are selling the right to buy an underlying asset at a predetermined strike price to another investor in exchange for some premium income. Thus, if the underlying asset's price moves above the call strike price or below the put strike price, the fund would experience a loss. And losses may be significant, and thus exchanges require a capital commitment to help secure the transaction. This is similar to margin in a futures contract in that the commitment is less than the market exposure of the contract. Thus, depending on how many contracts a fund sells, it may lead to significant leverage within the fund. And this is important to understand, as it is these option dynamics that greatly influence the shuttering of the LGM Preservation and Growth Fund in 2018, which we will touch on more later. The other two primary derivative contracts used by registered funds are forwards and swaps. They represent a direct agreement between two parties. As such, the two parties dictate the terms of the contracts as opposed to an organized exchange. This may lead to widely varying terms, but generally the contracts result in an exchange of cash flows based on some underlying reference assets. And these can be rather straightforward, as is the case with currency forwards and interest rate swaps, but they can also be quite complex, as may be the case with total return swaps and credit default swaps. The bottom line is that derivatives are complex, and the exposure they derive may be difficult for investors to understand and or be perceived depending on what a fund company reports to investors. Furthermore, derivatives can be used to acquire leverage within a fund, which may lead to significant losses and may create additional liquidity and counterparty risks for investors, which again may be difficult for investors to discern. This is where the derivatives rule comes in, as it looks to mitigate certain of these risks by imposing various requirements and limitations on funds that use them beyond a limited capacity. Originally proposed in December 2015, the rule was shelved by the new administration and then reproposed in November 2019 before ultimately being adopted in its current form on October 28, 2020. Per the press release, the rule sets forth two major changes for funds that use derivatives. The first is a requirement to implement a written derivatives risk management program. The program must include risk guidelines, as well as stress testing, back testing, internal reporting, and program review elements, all of which shall be administered by a board-approved derivatives risk manager. The second is a limitation on fund leverage risk, as defined by value at risk. Value at risk, or VAR, as it is commonly referred to, is a statistical measure for estimating greatest expected loss over a given time frame for a specified level of statistical confidence. The final rule requires the fund's VAR model to use a 99% confidence level in a time horizon of 20 trading days, which means the VAR would equal the most an investor could expect to lose over a period of 20 trading days with a 99% confidence level. Put another way, the VAR would be the amount in which there's only a 1% chance the fund could experience a loss greater than over a period of 20 trading days. Now, per the rule, this calculated VAR becomes the reference point for capping risk in a fund. It is not permitted to exceed 200% or twice the VAR of the fund's designated reference portfolio. The designated reference portfolio, as it is being called, may be either an index that meets certain requirements or the fund's own underlying securities portfolio. If the fund is unable to designate the reference portfolio, then the fund would have to comply with an absolute VAR test in which the absolute VAR, or the greatest expected loss, could not exceed 20% of the fund's net assets over a period of 20 trading days. There are a couple other components to the rule relating to financing activities, but these are the two primary rule changes surrounding derivative use. So let's look at the key takeaways. The first is that these changes will provide an exception for funds that use derivatives in a limited capacity. The SEC defines this to be funds whose exposure is less than 10% of its net assets. Speaking freely here, I was a little surprised to see this so low, as there are many funds who use derivatives solely for the purpose of hedging foreign currency risk and or interest rate risk. And given the additional reporting requirements, it will be interesting to see if this ends up creating additional costs for funds, for investors, for funds who are merely looking to hedge portfolio risk through derivatives. Second, many large fund companies who use derivatives as material components to their investment strategies already have dedicated trading and risk management staff for these efforts. Thus, complying with the risk management program may have an outsized impact on smaller fund companies who may have to expand resources into said efforts, which could potentially increase costs for their investors for said funds. Third, the VAR-based framework provides flexibility for fund companies under the original derivatives rule proposed in 2015. The rule would have required funds to comply with one of two alternative portfolio limitations. The first was an exposure-based limit that would have capped aggregate exposure to 150% of the fund's net assets. The second was a risk-based limit that would have allowed funds to obtain exposure up to 300% of the fund's net assets, provided a risk test was passed. Now, in either case, the rule would have significantly impacted and or curtailed the ability of funds who use derivatives to execute their investment strategies. As discussed earlier, leverage can easily be above the 300% limitation proposed, which we observe frequently across our own alternative mutual fund coverage universe. One of the major arguments against the original proposal was that the limitations failed to consider the underlying risk of the contracts. Now, for example, notional exposure for interest rate swaps and other fixed income derivatives can be quite high, given the lower relative risk compared to higher risk assets such as equities. The VaR measurement considers these differences. Furthermore, by making the VaR benchmark a designated reference portfolio that is consistent with the fund strategy, the VaR limitation is somewhat normalized across strategies of different risk levels. These rules, compared to the original market-based exposure limitations, provide fund companies increased flexibility to continue executing their strategies using derivative contracts. How much this ultimately limits a fund's use of derivatives will largely depend on the designated reference portfolio. And as funds within our coverage universe that fall under the regulatory purview of this rule begin to comply, we will certainly work with said fund companies to understand any impacts to investor risk and strategy execution and provide updates accordingly. Lastly, I want to spotlight the rule provides updated guidance on leverage and inverse ETFs, which prior to the rule adoption required an exemptive relief for running leveraged and inverse strategies. The SEC stopped granting these orders in 2012, and thus Direction and ProShares have been the only ETF issuers to offer said products to date, although other providers have been able to offer similar products in the form of exchange-traded notes. Now, with the new rule adoption, ETF issuers can now readily launch leveraged and inverse ETFs, assuming they comply with the recently adopted ETF rule and the new derivatives rule. This means that any future product would be capped, though, at that 2x. The final rule provides an exception from the VaR requirement for leveraged and inverse funds currently in operation, though, that seek an investment return above that 2x. Assuming certain conditions are met. All right, with that, the new rule and related rule and form amendments will be published in the Federal Register, after which the rule will be effective following 60 days. Upon being effective, fund companies will have an 18-month compliance date. Now, as of November 16th, the rule had not been published, and we now have a new administration coming in, thus we will see how this unfolds here in the coming months. The rule will look to protect investors from certain risks created by derivative investing, while providing funds a latitude to invest consistent with modern financial market developments. And this is important as leverage can lead to significant losses for investors. In recent history, this risk was notably demonstrated by the LGM Preservation and Growth Fund in 2018. The fund wrote put option contracts on the S&P 500 as part of its investment strategy, which created essentially a short position on volatility. In early February, volatility spiked significantly in an event that is now referred to as Volmageddon, leading the fund to lose more than 80% in a period of 2 trading days. The fund ultimately closed and was the subject of various investor complaints and lawsuits. As such, it is important when considering or investing in any product that uses derivatives to fully understand the implications of the strategy. A category where derivative use is widespread is the liquid alts category. And here at AI Insight, we offer a research platform that covers certain mutual funds executing alternative investment strategies, where we look to provide advisors assistance in understanding these complex strategies. So for more information, feel free to visit our website at aiinsight.com. With that, though, we will bring this podcast to a close. And just want to say thanks again for tuning in.